Sir, we can start. We are live now.
Yeah, perfect. Hi, good afternoon to everyone. This time, due to unavoidable work pressure, we couldn't circulate presentation earlier, but we think it's better to deliver a quality product rather than timely product. Uh, if we look at the global economy, Avinash, can you move the slide? The central banks around the world continue to print the money. The negative debt continues to pile. More than 75% of debt continues to trade below 1% in yield. This has resulted in a scenario where interest rates have come down dramatically all over the world, which in turn supports fund flow into equities. The risk appetite of market has gone up. And if you look at the next slide, companies which are loss making or which are not profitable, they are all able to raise record money in IPO in US market. Obviously, when liquidity is high, it does put pressure on commodities. And we have started seeing commodities like soybean, wheat, corn started moving up. Agriculture commodity is rising, and so is industrial commodity. Local steel prices were 40 rupees a kg, now they are 65 rupees a kg. Packing material cost is up 4-5%. Chemicals, dyes, intermediaries cost is up 10-12%. So we are seeing slowly and steadily commodity prices moving up. If we come to Indian economy, in the month of Jan 21, following were headlines. GST collection, fourth month in a row above 1 lakh rupee, all-time high of about 1,20,000 crore. Power demand continuously running at all-time high. In Jan, it was 185 gigawatt. Today, it is 189 gigawatt. And people are expecting India crossing for the first time 200 gigawatt. India's manufacturing PMI improved to 57.7 in January. Services PMI is also higher. Foreign exchange reserves hit a new lifetime high. The bank credit growth rose to 6.6%, and Indian exports grew by 5.4%. Clearly, there has been fair amount of positivity across various headlines. More importantly, active cases fell to 1.55 lakh, and more than 44 lakh people have been vaccinated. India's vaccine diplomacy is winning rave views from all over the world. And some of the international celebrities, instead of appreciating India for sending vaccine, are busy talking about some other irrelevant issues. India's quarterly GDP contraction will end in December quarter as per National Council of Applied Economic Research. This is 3 months ahead of RBI's estimate. Let's hope and pray that that turns out to be true. India in calendar year 2021 will be one of the fastest growing economy as it is coming on a lower base. There are a couple of factors which are putting India on the firm path of growth. One is production linked incentive scheme. This can add about 1.6% to India's GDP on an incremental basis. This PLI scheme is showing tremendous attraction among investors, and it is available across mobiles, autos, battery, pharma, food, textile, telecom, and other industries. This is one of the best structured schemes to attract companies out of China and help them set up their base in India. India's electronic exports have jumped from 5.7 billion to 11 billion, and with PLI scheme, it will get further momentum. The other factor which will influence India's GDP growth is real estate industry. Interest rates have come down, affordability level is increasing, real estate prices are stagnant, stamp duty concession is given. We believe 1% incremental GDP growth could come from liquid from real estate and housing related industry. If you look at the budget, it reminds me of an old Hindi movie, Sita or Geeta. In that movie, Hema Malini played character of Sita, a shy girl, fearful girl, and Geeta, which was daring, which was adventurous. This is the budget which is transiting India from Sita to Geeta, from being introvert to extrovert, from being always fearful to being willing to face the world. If you look at the budget, it's an Atmanirbhar budget where we humbly tell rating agencies that we appreciate your sermon on fiscal prudence. We will follow that path on our terms, not on your terms. We will spend money to support economy like US, like UK, like Japan, and we will also pursue path of fiscal prudence unlike them from FY26 when fiscal deficit to GDP will be 4.5%. This is budget of confident India for accelerated growth. Its minimum government, maximum governance, its import duty protection against Chinese dumping, its PLI scheme to attract companies out of China to India. All steps are taken so that growth can accelerate. This is bold India's budget for healthcare. Wuhan virus impacted our economy and our citizens. India is one of the few countries in the world which readied vaccine for delivery. Not only India is vaccinating its population by spending 35,000 crore, but it is also providing vaccines to rest of the world so that they can tackle Wuhan virus. This is the budget which equips our defense forces to take enemies on two and a half front, China, Pakistan, Nepal. This could be potential trigger zone for India. And we had to equip our defense forces so that they can take on all the two and a half fronts in case the need arises. For 70 years, India's growth was restricted and constrained as PSUs kept on dominating one specter after another. Now we are discarding restrictions of the past. 7 PSUs are targeted for privatization. The operative word is privatization, not divestment. Divestment was market related. You sell bits and pieces. Privatization is creating public private partnership, handing over company to entrepreneur who will run it better. We believe divestment estimate of 1,75,000 crore in budget is fairly conservative number. If government does a good job in divesting BPCL, LIC, this number could easily be achieved. So this is transformation of PSU for India's economy. This budget is ambitious for building infrastructure. This budget is building roads, railway tracks, and other necessary infrastructure. Dedicated freight corridor will be a game changer for India's logistics cost. Today, our goods train run at 21 kilometers an hour. I'm sure most of you would have seen a video where a double stack container train runs at 100 kilometers an hour on dedicated freight corridor. Once DFC is operational by June 2022, a full 2 years behind original schedule, India's logistics cost will come down. In export market, we will be able to ship goods faster. And most importantly, working capital will come down for industry. This budget is innovative budget for raising resources. For years, finance minister will say, I'm willing to spend, but I don't have money. Now government is monetizing its existing assets, railway land, defense land, oil and gas pipeline, warehouses, transmission lines, stadiums. All assets could be monetized to create new assets. This is absolutely necessary as world is moving towards digital infrastructure. Unless we monetize physical infrastructure, we will be left behind in creating digital infrastructure. This budget is progressive for women empowerment. We talk about women empowerment, but we don't empower them. In service industry like banking, insurance, technology, hotel, aviation, women were allowed to work. However, in the factories, women were not allowed to work during night time. Now, in this budget, we are allowing women to work during night time. In April 2020, Franklin Templeton had to announce winding of six schemes as credit markets had become illiquid. This budget has proposed to set up a buyer of the last resort in bond market. They will buy investment grade securities at market clearing. This will ensure that in future, credit markets don't become illiquid, credit market doesn't freeze. This budget is also empowering taxpayers. Honest taxpayers suffer because dishonest taxpayers don't pay fair share of taxes. By giving pre-filled income tax return covering capital gains, dividend income, interest income, there will be expansion of tax base, tax collection will go up, and hopefully tax burden will be shared by honest as well as dishonest tax citizens. This budget is also transparent. Transparently, it has taken over all the off-budget items like food subsidies from NH, from FCI balance sheet. Overall, this budget is pro-growth budget. This budget is bold like 1991 Dr. Manmohan Singh's liberating budget, like dream budget of Mr. Chidambaram. This is the budget which lays foundation for double-digit growth for India in the days to come. Next slide shows the fiscal deficit, revenue deficit, and primary deficit. Undoubtedly, these are higher numbers and they need to be tackled with careful execution. The government is spending money on its balance sheet as well as on the public sector undertakings. The growth in capital outlay of government is roughly 4.8% and overall is roughly 10%. Next slide shows PSU capex growing at 9% to complement government. This capital expenditure trend on the next slide shows across various ministries from defense to road to railway. This lays the foundation for India to move from infrastructure deficiency to infrastructure surplus. Today, our roads are less congested than before. Today, our power problem is related to distribution, no longer on the generation side. Metro work is going on, improving public transport by leaps and bounds. Rural road connectivity is superior. All those things put together, we will create India which can take on the world competitively. The PSU divestment is most critical. There are companies which needs to be privatized. There are companies which needs to be listed. And clearly, execution is the key in terms of divestment. Next slide shows budget generally impacting positively to most sectors from banking to agriculture to telecom. This budget is declaration of intent. It requires flawless execution. If you remember old Mahabharat story, when all the princes were being taught archery, one day Guru Dron hold the competition and asked the princess to shoot a bird's eye. Whenever prince was coming, Guru Dron will ask, what are you seeing? And all the princes were saying that we are seeing bird, we are seeing trees, we are seeing leaves, we are seeing background. Finally, Arjun was called. And when Guru Dron asked him, Arjun, what are you seeing? He said, I am only seeing eye of the bird. That's the kind of execution which we need for converting this budget to reality. This budget is declaration of intent. It needs to be met with flawless execution. For years, we tried divesting Air India. Next year, we must. For 2 years, we tried divesting BPCL. Next year, we must. Last year, we tried listing LIC. This year, we must. So this budget requires flawless execution in order to convert this intent, this optimism into reality. What are the risks to the market and economy? Well, the biggest risk continues to remain COVID-19. Coronavirus has hit Portugal so hard that they have to send patients to other countries for ICU treatment. Whether we look at US, where every day 9/11 is happening, more people are dying every day in US because of COVID-19 than World Trade Center collapse. UK, they have extended lockdowns. Germany, they have extended lockdowns. COVID-19, fortunately for India, seems to be under control, but we can't be complacent. We need to ensure that the second or third wave of infection does not come and hound India like it is hounding Portugal, UK, US. We have to take care against mutation of virus. The second worry is rising commodity prices. This entire growth which budget is planning can be achieved in a moderately inflationary economy. If inflation rises all over the world, interest rates will rise, liquidity will tighten, and that could create a vicious cycle of high interest rates and tight liquidity hurting economy and hurt economy impacting valuations. The third factor where we, like coronavirus, seems to have some control is unemployment ratio. In the month of December, unemployment was about 9%. And as we speak on 4th February, unemployment has unemployment has fallen down to 6.2%. Urban is a little higher at 8%, and rural is significantly lower at 5%. This unemployment needs to be tackled even further, because what we believe is that maybe jobs have come back, but the income levels have not yet reached previous pre-COVID level. So inflation, unemployment, and COVID-19 continues to pose risk to the economy. From an equity market point of view, fund flow has been fantastic. We can legitimately say, Sare jahan se acha Hindustan hamara. We are one of the few countries in the world which continues to receive positive capital flows. We have received $24 billion worth of flows between Jan 20 to Jan 21. More importantly, retail investors is also contributing into this buying. The retail ownership of equity is rising for after years of falling. Between retail and foreign portfolio investor, we have really gone up in terms of flows into the market. If you look at performance across market cap, now small, mid, large, all have started running up. Calendar year, the performance in Jan was down, but moment you look at it on 4th of February, all numbers will turn positive. Flows and sentiments could be fickle. What you need is fundamental. And I want to talk about results declared for December 20 quarter. Of 102 companies which MOSL covers, they were expecting sales to go down by 1%, 2%. Actual degrowth was more or less in line at just 1%. They were expecting EBITDA to grow by 16%. Actual EBITDA growth is 24% for this 102 company. They were expecting profit before tax to grow at 19%. Actual profit grew at 36%. They were expecting PAT to grow at 13%, and actual profit growth came at 32%. If we look at Nifty 29 companies, which is subset of this 102 companies, the sales degrowth was more or less same at 3%. But profit after tax grew to 24% against expected 4%. This is tabla tod results coming out of corporate India. It's way beyond everyone's expectation. These are some of the quarterly results I want to show you across various sectors. This is not the recommendation to own any of these stocks. Please do your research. If you want to buy this stock, don't say that Kotak Mutual Fund put that into their monthly presentation and hence we bought. Look at the sales growth of a cement company like Ultratech. In the month of March as well as June, sales were down 13% and 33%. In December, they are up 17%. A plastic processing industry, sales were down in December and March and June of the previous year, but now it is up 34%. Asian Paint sales up 25%, Havel sales up 40%, Pidilite sales up 19%, PI Industries sales up 37%. There has been tremendous growth in sales in December quarter. It's kind of indicating that this is not the economy which is growing at negative rate. These are the numbers which we didn't see even when our economy was growing at 7-8%. Most importantly, look at the profitability growth. Ultratech, for last 2 quarters, their profits are up more than 100% year on year. Supreme, last quarter 81% up, this quarter 143% up. Asian Paints 35% up last quarter, 61% up this year. Havels 100% plus up in last 2 quarters. JSW Steel 200% and 700% up in last 2 quarters. PI up 55% in last 2 quarters. These numbers, when they come, they bring down PE ratio instantly. This is the kind of profit growth we are seeing across corporate India. Mind you, this is not the recommendation to buy any of the stock. This is just to show you how results are moving. At this level of market, we think valuation wise it is neutral weight, and momentum wise, if one wants to remain overweight, it can probably remain overweight from a momentum point of view. If you look at valuation, market cap to GDP ratio now is above 100%. This was the number as on Jan, but in last 4 days, markets have gone up 10%. Compared to our historical average of 75% market cap to GDP ratio, 98 looks higher. But global market cap to GDP ratio is 115%. Compared to that, 98 looks lower. If you look at price to earnings or price to book, the consensus forward earning is 19.9, slight premium to 18.7 for 10-year average. The book value is 2.9, slight premium to 2.6 historical average. So valuation wise, we believe market is fairly priced. Let me show you the difference between trailing earning and forward earning. This is the profitability of all the companies covered by ICICI Securities. Their profitability in December 19 was 1,17,000 crore. March 20, it came down to 78,000 crore. June 20, because of lockdown, came down to further 61,000 crore. And September 20, it bounced back to reach 1,75,000 crore. If you take the total of that number, it's 4,32,676 crore. Yesterday, India's market cap crossed 200 lakh crore for the first time. You take last 4 quarters earning, the P ratio comes at 46 times. If you annualize September quarter profit into an annualized number, the profit becomes 175 into 4, 7 lakh crore. The P ratio drops to 29. In September quarter, India Inc. reported highest ever quarterly profit. This is the kind of profitability growth we are seeing. On a trailing basis, what is looking 46 times past earning, on a forward basis suddenly looks like 29 times forward earning. And this is just on the September quarter annualized number. December numbers could be higher. If we annualize, this ratio may fall to 25 on so. At this rate, we believe small and mid cap is something where you could be marginally overweight and you could be marginally underweight in large cap. Overall, you should have neutral equity allocation. If you look at SIPs, they have delivered fantastic result. In Jan 20, most of our SIPs were delivering double-digit return across various periods. In March 20, that dream became nightmare as we started delivering negative return for up to 5-year period. Today, when you look at Jan 21 number, most of the cases, we have started delivering better return than Jan 20 itself. We have never seen such kind of volatility in SIP returns. But people who continued maintaining their SIP, doing their SIP, people who topped up SIP when returns become negative, today are laughing all the way to the bank. Next slide, please. Go to asset allocator slide. This is one fund which I want to talk about. We are guilty of not promoting this fund earlier, but over last 1 year, we have been pushing this fund. This is the fund where all your retail investors should participate for whom you can't do effective asset allocation. This portfolio is divided between debt funds and equity funds. And you can just look at the performance over last 1, 3, 5, and 10 year. It's all in double digit, significantly above its benchmark index, and also delivering pretty good return over equity funds despite having lower allocation in equity. This is the fund where people can fill it, shut it, and forget it. This is the fund which you should be selling to 80% of your clientele who are retail and for whom it will not be appropriate for you to do the asset allocation. If people are worried about lower interest rates scenario in the country, they can look at Kotak Debt Hybrid Fund. This fund has delivered either low double-digit return or high single-digit return over a long period of time. This fund invests up to 75% in fixed income and up to 25% in equity market. Similarly, on the large cap side, we will recommend people to consider investment in well-performing large cap funds. And Kotak Blue Chip is one of the large cap fund which has been able to outperform its benchmark index despite several restrictions. In terms of gold, our fear of cut in import duty came true in this budget. We were highlighting that rupee gold prices could come down as import duty comes down. This budget, import duty has been rationalized from 12.5% to 10%, and which is why gold prices came down by 2.5 to 3%. If import duty is reduced further from 10% level, to that extent, rupee gold prices will come down. But gold prices have corrected 20% from top, and we think now this is the time to accumulate gold on a longer term basis. One can consider investment in gold ETFs for participating in the upside of gold. A lot of social media messaging is being done that funds are not generating alpha. Nothing can be further from truth. If you see in India, because of transaction cost and the way index is structured, even index funds fail to outperform benchmark indices. The median Nifty index funds underperforms Nifty by about a percentage point. A median Sensex fund again underperforms Sensex by about a percentage point. If you look at our equity funds, they have serious limitation in terms of construct. They keep cash to meet redemptions. Index is fully invested. The funds cannot take more than 10% in one stock, but in Nifty index, two stocks, HDFC Bank and Reliance, has more than 10% weight. Infosys also was threatening to reach that level. In index, stocks are changed, added or reduced or removed at the closing price. But in stock market, there is always impact cost. More importantly, we compare our fund performance with total return index, whereas globally, gross of fund is compared with total return index. If we look at all those restrictions, and yet our equity funds have delivered alpha over benchmark indices over 1, 3, and 5 year horizon. Of course, there are periods where we have not been able to deliver alpha, but they are far and few, and we hope that over a period of time, we will be able to deliver alpha from across all the time periods. When you look at SIP, can you keep it on SIP slide, please? When you look at SIP returns, again, across time periods, we have delivered alpha. In some cases, we haven't delivered alpha, but hopefully over a longer period of time, we will be able to add value to our clients' portfolio. There are many people who are saying that by going directly into market, I am making money. Well, that's not the case. Many people have made money going directly into the market, but they may not have made as much money as mutual funds have made. Some of our funds are up 100% from the bottom of March 20. This is calculated as on 31st of Jan or 2nd of February, sorry. It's calculated up to 2nd of February. And many of our funds have jumped from the bottom in 90%, 100% category. Next slide, please. Coming to the fixed income market, there is ample liquidity in system which RBI is trying to take away. There is a CRR hike coming in March and April. There is variable reverse repo which RBI is conducting. Overall system liquidity is 9 lakh crore, but official liquidity visible to the market is roughly about 4 lakh crore as RBI absorbs 5 lakh crore. The short-term rates have started bouncing up a little bit by 30 to 50 basis points as RBI sucks away the liquidity. The consumer price inflation for the first time in calendar year 2020 came below RBI's target level of 6%. The last number talked about consumer price headline number at 460 and core inflation at 550. The market got spooked by the size of the borrowing program. The gross market borrowing program is 12 lakh crore plus in this budget. At 12 lakh crore, it is comparable to this year's gross market borrowing program. Hopefully, RBI will be able to manage this borrowing program in a fair manner. It will not have material impact on interest rates. And this should ensure that interest rates remain in a range-bound fashion. The borrowing calendar, as I mentioned earlier, has pushed interest rates up. And even in today's credit policy, interest rates have gone up by 5 to 10 basis points. The FPIs, after buying in September, October, November, December, again has turned marginal sellers in the month of Jan. Their behavior is to take bets out of India whenever there is a rally. As of today, if you look at from a spread point of view, the corporate spreads on AA rated paper looks attractive, looks higher, and it is time probably to consider investment in banking and PSU debt fund, in corporate bond fund, in dynamic bond fund, which will benefit from the current positioning of spread. The spread on state development loan also appears attractive, and we have been keeping fairly good position in state development loans. In terms of yield curve, today spread between 10-year minus 1 year is roughly at 185 basis point. It is down from previous 250 basis point as short-term rates moved up, but medium-term rates haven't moved as much. If you look at debt market, it is extremely important to predict interest rate movement. We think interest rates are upwardly biased with range-bound movement. It will probably end at 6.5% over next couple of months, but it will not go beyond that unless until RBI, really does not manage the borrowing program. We believe RBI will manage borrowing program with same elan like last year, like this year, and hence there is limited scope for interest rates to move higher. In Kotak Mutual Fund, we have always invested in highly safe portfolio, high credit rating portfolio. Today, 94% of our portfolio is invested into AAA and sovereigns, and only 0.42% of portfolio is invested into below AA minus rated paper. Our portfolios continue to remain liquid, and it gives reassurance to investors that whenever they will demand their money back, we will be in a position to pay it back. From a debt investment point of view, one needs to bring to the attention of investors the solid return which debt funds have provided, be it gilt fund, dynamic bond fund, PSU debt fund, corporate bond fund, bond, short-term, and even credit risk fund, they all have delivered higher single digit or lower double digit return over last 3 years. Our dynamic bond fund continues to outperform benchmark indices, and Deepak and Lakshmi continues to manage. Deepak, Lakshmi, and Abhishek continues to manage this fund in a great manner to ensure that we are able to contain volatility and deliver good return to our investors. Another fund which one can look at is Kotak Medium Term Fund. It had higher allocation to credit risk papers. Now it has been adjusted in favor of high credit papers. And at this point of time, with 4.57 years of maturity, it is ideally positioned on the yield curve to benefit unit holders. Let's move forward. In terms of distributor engagement, we have a website where we provide video learning platform. More than 10,000 distributors have benefited from ProStart. And depending upon your feedback, we are adding new videos for learning. You can log in at any point of time and you can learn at your convenience. You can also subscribe to our business hub where we co-brand all the materials, literatures which we produce, and this can be used for circulation to your customer. Very recently, we came out with a very interesting presentation about the importance of mutual fund distributors. In this presentation, we have shown social media noise and compared that with what a sane distributor will advise. In the month of March, lots of social media noise was about how equity markets have fallen, how dark days lies ahead, how COVID-19 will impact us. And the message was that you should redeem out of equity fund. People who listened to their distributor advisor, they saw their portfolio going up by 80, 90, 100%. In the month of April, when Franklin Templeton announced winding of 6 schemes, there was mayhem. Social media was advising redemptions from debt funds, not only credit funds, but also debt funds. Again, people who listened to their distributor and stayed back are today reaping double-digit returns. Throughout March, April, May, June, we heard noise against SIP, how SIPs were being paused, how SIPs were being stopped, how SIPs return was lower than public provident fund account or provident fund return. There was social media campaign to derail SIPs. Again, people who listen to their distributor realize that SIPs, you have to continue through ups and downs. And in Jan 21, they have better return on SIP than what they had in Jan 20. Very recently, we saw again one more malicious move against mutual fund, saying that they are going to default. Again, people who listen to their distributors, and now people have become wiser. They have been ignoring malicious campaign. They stayed invested, and there was virtually no impact about that campaign on our numbers. All these presentations are available for you for co-branding with your brand, with your logo. You should be in a position to circulate that to your customer. This is all what we have to talk about the market and budget. Happy to take